After months and months of nothing to report, we finally have a flurry of activity in the UK. We have a new Prime Minister, we have a new cabinet, and the probability of a no-deal Brexit seems to have risen sharply. There's an old line that says that politicians campaign in poetry but govern in prose. We can certainly say that Boris Johnson campaigned in poetry, but so far he seems to be doing the same thing in government. Now, some of that is clearly for the benefit of his domestic audience, and also perhaps for the audience in the European Union. But at some point, that poetry has to translate into proposals. And the current proposal, in the absence of anything else, is to leave the EU without a deal on October 31st. What does that mean for financial markets? We'd argue that we'll see downgrades to GDP growth in the UK, and perhaps to a lesser extent in parts of the Eurozone, and weakness in sterling relative to other major currencies. We've already seen the second part of that in the last couple of weeks, with sterling weakening particularly against the dollar. And we'd argue that over the last couple of years, the uncertainty around Brexit generally, even though nothing has yet changed, has had an impact particularly on business sentiment and business investment. Now, that varies by sector. There are clearly some sectors that will be very significantly impacted and some that see less relevance. But overall, we'd argue, the trend is down. Now, from a market's perspective, there are a couple of implications. From the perspective of UK equities, the FTSE 100, the large cap index, has a very global exposure. Something over 70% of its revenues possibly come from overseas. That means that it's a relatively good hedge, up to a point at least, against sterling weakness. The mid-cap space, middle-sized companies that are listed, those are a bit more domestically focused. And we'd argue it's there that you see perhaps greater risk to earnings, to corporate profitability, and perhaps to valuations. It's easy to dismiss Boris Johnson as a number of things. Ill-disciplined, lacking in attention to detail, not serious, and these are criticisms that have been leveled at him throughout his career, even as he's climbed the greasy pole of politics to number 10 Downing Street. We should also remember, though, firstly, that he's had significant staying power in the face of a number of setbacks over the years, and secondly, he's not alone. He has a number of advisors, a number of supporters, a number of colleagues who have both the brainpower, the discipline, and the focus to drive the UK towards their preferred outcome, be it a new negotiated settlement or a no-deal Brexit. The bond market is maybe more interesting. In the event of no deal, we'd expect to see bond yields fall, driven by concerns about UK growth. There's maybe some question about how government spending would react, and we'd probably expect to see government spending increase to try and offset some of the impact of no deal. We'd also expect to see some response from the Bank of England to make sure that financial stability is maintained and that there's sufficient liquidity in the system. Overall, however, over the next 12 to 18 months, in the event of no deal, we'd expect those yields to decline.